Hello, YouTube and StockTwits. We're creating a little awareness today. Today is Sunday, and I'm Bagadon at Stock Market Caddy. Today is June 30th at about 5 minutes of 4. The markets will open in another 2 hours, and we'll get a flavor for the Trump effect and see what we have here. Be a very interesting overnight. It will be a very interesting week. Now, ordinarily, a couple of things. One, it being the 4th of July, you would expect low volume, and low volume is not the best markets to sell short or to sell, period. They have a tendency to run up. And the other part of it is that if we haven't had now. The last meaningful pullback that we had was the last 2 weeks of May. And we said it to our members. I wish I had listened to my own words a little more closely, because they said at the end of May, we got to be careful. They could be scooping up some shorts to capture and burn as we get into contract rollover and into the Fed, which is frequently what happens. Most of the important Fed meetings, if not all of the Fed meetings, always happen on a contract rollover, and that is usually the second, third Friday of the expiring month, which was back in June. And what happens is the volume at that time also disappears, and the Fed will come out with a headline, and the bank of choice, whether it be Citadel or any one of the five or six member banks of the cartel, will do what they got to do to make sure that the Fed gets the effect that they want, which is usually up. So we got all of that. We got all of that manifestation. But I also said at the time, what is giving me angst, it's giving me some gas, is that immediately following that, we, of course, knew about the President Xi meeting, because it was announced, back before the pullback in May, when they were trying to, salvage this piece of crap. Now, when I talk about piece of crap, I'm talking about this market. I mean, it's as wobbly. It's very wobbly. And if you remember, back in May, the Fed had to come out and say, "Hey, we're prepared to do whatever we got to do to hold it up." But don't get fooled into thinking that the Fed is out to keep the market up at new highs. What I do think the Fed is trying to keep the market from crashing. There's a big difference. The neophytes will think that, the Fed's got to put on, and we're going to just keep piling in the market. Well, I do think that the Fed has a put of sorts on, but I don't think it's up here. No, not at all. So it's all relative. Just like the crooks that used to fix horse races up in the Northeast. They knew the winning horse was going to be checked to make sure that the horse wasn't drugged. So what they would do is they would drug. Seems like the right word. I don't know. But they would they'd drug all the other horses to slow them down, and the winning horse would get checked, and his blood was clean. So it's sometimes not what you think. And now I'm speculating. It's wild-eyed speculation. But I really don't think the Fed is out to drive the market deliberately and intentionally up over 3,000 to 3,100, 3,200, 3,300, because the further they do that, the worse the pullback of the correction, the test of the market lows back in May, and we are going to have to test those. We got gaps underneath, is going to be even worse. So don't be surprised that now that we're through the Fed meeting, and we're through the Xi meeting, and the historic. I mean, I thought when I read about the history of who was it, the general with the MacArthur. When MacArthur would have to, isn't it fitting though? You know, that MacArthur had to do the same thing. You know, he staged that, you know, I will return business. He got his ass out of the Philippines. He let all the troops, you know, march to Bataan. But he got his ass off there, him and his crew. And then when he came back, you know, they had to stage, you know, his big scene, I will return. I'm digressing a little. But MacArthur, you know, back during the Korean War, I'm reminded of Trump today of MacArthur. MacArthur, after World War II, you know, he spent about 10 to 15 years. He hardly ever came back to the States. He was the royal emperor. You know, he was the big muckety muck over in Japan, and everybody was kissing his ass. And he got us involved into Korea. And he did the same stunt there when they landed. It wasn't at Incheon. It was at a bay a little bit south of there, not nearly as dangerous as Incheon. And he did the same stunt. You know, I'm reminded of Trump, you know. I will return, and I step foot. I'm the first American president to step foot across the DMZ. You know damn right well if they were doing any shooting, that son of a bitch wouldn't have been anywhere near the DMZ. You know, and I'm sorry, I can't give him a pass because just last week we're on the verge of World War III with the Iranians, you know, shooting down our drones, and with all likelihood, if not a rocket made by North Korea, certainly with, you know, the technology, and here he is over here, you know, grandstanding, and I mean really just the grandstand. So, in any case, I digress. But the point is to the market. Don't always believe what the narrative is. And the narrative is, you know, we're all going up, we're all going to 3,000, and then once it gets to 3,000, there's no stopping it. We're going to 3,500, we're going to there's nothing going to stop it. Yeah. Reason being, I've seen it before in other markets. I'm not saying that I know that it isn't. I'm just saying, be careful, be guarded, because when gold made its run from 1,500 to 1,600, 1,700, 1,800, 1,900, I mean, 2,000 was a given. They stopped predicting 2,000. We're going to 2,500. We're going to 5,000. You know what it went to? And it was on a Sunday night. It went to 1,992. I went up there quickly. And that was it. Until just now, you know, I mean, gold got into its own bear market. Never did make 2,000. And the noise couldn't have been any louder for gold at that time. Now, I'm not bearish gold. Not here, not now. But I was then. And this market is wobbly. And let me show you technically another view. Now, unfortunately here, this is a black backdrop on this chart. So hopefully everyone can see this on YouTube. Our videos are high definition. This is what we call the percent B. The percent B. This is John Bollinger's product. And what it shows, what's important, is when price punches through, and this is the standard Bollinger. Let me just explain what you're looking at. This is a bar chart on the S&P 500. It's a daily chart, not a weekly. And this is the first Bollinger. This is the second set of Bollinger. Now, what we do know is that price moves and stays within the Bollingers about 80% of the time. Well, once we know that, then we want to pay attention to what happens when price punches outside the Bollinger. And that will give us a hint as to where the next move is. How so, Bagger? By the way, I'm Bagger Don, Stock Market Caddy. So, give you for instance, see these punch outs on the upper side? They're marking at the time what they call true value. And you see what happened up here? Price went higher than this price right there. Right there. Price went higher on a daily basis, and the percent B did not. That was showing, once again, something we like to comment on is divergence. That meant that the enthusiasm was drying up, and it was making a what we call a false high, and then And there were some other signals in here, but very quickly down it comes. Now this mark here, this is a true low. So let me show you what I mean by this. This is using Bollinger's, and right here, see this low here? That low, let me just show you, that low was 2801. That was a true low, because the percent B is way below here. Very true. Now look what happens here. We come down. We make a lower low than there. How low did we go? We went as low as 27.28. And then we stopped going lower. We went higher, and we closed higher. This should have been bought, because this is a false low. Now you're all saying, oh yeah, sure thing, Baggy, you tell us now. No, we told our members this, okay? And we have systems that track this sort of thing too. So I'm just explaining it to you. They do this, they can do this automatically for us, but no, we told our members, so I can't be fibbing here. And we told everybody this is setting up for false low. How do we know that? Look where the percent B was. Price was lower than, this was the true low, but price went lower, got tested, actually went lower, but the percent B did not. The only example I can give is if someone punches their hand through the wall, okay, after, the Red Sox, lose a ninth inning, World Series to the Yankees, okay. I'm only kidding. They punch their hand through the wall, though, the first time, and it goes, right through the wall, and they go right up to their elbow. The next time it happens, they punch the wall, but you know what? They don't punch it quite as hard. It doesn't quite go through. But it went, same effect. It was lower down here. This tells us that this low is a false low, and it should be bought. Okay. Well, what are we doing up here, Bagger? Well, let me show you. This is why this is so dangerous. And this is on the S&P. Do you see but certainly this high up here? Let me centralize this. The previous high, most recent one, was 2964. 2964. Now, somehow or another, I think that number might come into play tonight. But at 2964, look where the percent B was. Now, 2964 was much higher than these true highs, which were back over here. And we pulled down. And now here we are again. We closed on Friday at, let me tell you exactly, 2941. Look where the percent B is. Way off. This is a false high. So if we go higher, and the higher we go, and if this percent B don't get up here, and get up here real quick, then the first day that this stops going up and turns around and makes a lower low, we are going to sell the crap out of the S&P, because that will be it. And then we're going to have, in essence, a false high. And we are going to come down, and we're going to come back to this low and test it. And the reality of it is, we're going to probably test these out again, but we're going to be down and down hard. John Bollinger, great guy, horrible speaker, great book. You got to really read it, though, about 10 times to understand him. I don't even think he explains the percent B as well as we do. I really like my analogy of punching through the wall. I think it makes sense. If you want to listen to him, by all means, he's the author of that. We'll give credit where credit is due. We've made a ton of great trades on it. So at the moment, and so this one here, this high, 2964, if we do open tonight, keep an eye on 2964. Watch it tonight. Watch it tomorrow, because I think that'll be the action. That'll be the resistance level. We might go up to 29.90, some craziness. I kind of doubt it, but Please understand, when we look at a chart or look at our systems, we ask ourselves first, where was the last trade? Here. Okay, this was the long, not up here. We do this all the time. You should have been buying here, selling here, buying here, selling. I don't have the time here because of YouTube. So the next trade, it's a sell, folks. It's a sell. I'm Bag It On, Stock Market Caddy. It's free to follow. Free to follow. We got 2 levels of membership. A monthly membership. A monthly where we'll do much better videos quality-wise than YouTube because we pay for the hosting service. And then we got a level 2. And level 2 entitles you to all of our automated and proprietary indicators and strategies. And we have these on point and figure, on Rinkos, custom Rinkos, mean Rinkos, Kagi charts. I mean, you name it, price charts. If you don't know what any of those are, that's a problem. If you didn't know about false highs and false lows, and you've been using Bollinger's for any length of time at all, man, that's sinful. Feel free to give us a call. 813-758-8263. I'm Bag It On, StockMarketCaddy.com.